The 60/40 portfolio delivered its worst performance in decades during 2022. The S&P 500 dropped 19.4% that year. Simultaneously, the U.S. aggregate bond index fell 13.0%. This simultaneous decline invalidated the core 60/40 assumption. Bonds are supposed to provide negative correlation during equity downturns. This fundamental hedge failed completely in 2022. Inflation, not growth concerns, drove central bank policy. The Federal Reserve aggressively raised interest rates to combat inflation. Higher rates simultaneously reduce equity valuations and existing bond prices. The historical negative correlation requires low inflation. It also requires stable growth expectations. This environment of stability no longer exists for investors. We must adapt our asset allocation strategies immediately. The old rules of diversification are broken. We need a new framework for wealth preservation and growth. This video details the specific assets that work now. The negative correlation between stocks and bonds typically holds below 3% inflation. When inflation exceeds 4%, the correlation often turns positive. This eliminates the intended diversification benefit completely. The 40% bond allocation in 60/40 was designed for deflationary shocks. It was not designed to hedge against high inflationary shocks. Structural economic shifts are increasing inflation volatility. These shifts include deglobalization and increased government fiscal spending globally. This volatility will likely exceed the 2010 to 2020 average. Investors must now assume a higher baseline interest rate environment. This means bonds offer less potential for capital appreciation. They also carry significantly higher duration risk. Bonds are now less effective as a portfolio stabilizer. We need assets that thrive when inflation is persistently high. A traditional 60/40 portfolio is heavily exposed to equity risk. Measured by volatility contribution, this exposure is approximately 90%. Modern allocation shifts focus from capital allocation to risk allocation. Risk parity strategies aim to equalize the volatility contribution of assets. These assets include stocks, bonds, and real assets. This approach typically results in a much lower equity weight. Equity might drop to 20 or 30% of the portfolio. Bond weight increases significantly, often to 40 or 50%. Leverage is often utilized to meet target absolute returns. The primary goal is maximizing the Sharpe ratio. The Sharpe ratio measures return per unit of risk taken. Risk parity ensures no single asset class dominates the portfolio risk budget. This structure provides superior performance across different economic regimes. It is a more robust form of diversification. Portfolios require specific assets that perform well when inflation is high. Real assets provide this necessary inflation hedge. These include commodities, infrastructure, and inflation-linked bonds known as TIPS. Commodities, such as energy and agriculture, benefit directly from rising input costs. Infrastructure funds often have contracts linked directly to the consumer price index. Specific real estate investment trusts also offer CPI-protected cash flows. TIPS principal value adjusts upward with inflation, protecting purchasing power. The coupon payments on TIPS also increase with the adjusted principal. A target allocation of 10 to 15% to diversified real assets is recommended. This allocation significantly reduces portfolio sensitivity to unexpected inflation spikes. Real assets maintain their intrinsic value during periods of currency debasement. Managed futures are essential for achieving true non-correlation. These strategies are often implemented via commodity trading agents, or CTAs. CTAs utilize systematic trend following across global markets. These markets include currencies, fixed income, equities, and commodities. CTAs generate what is known as crisis alpha. They profit from sustained downward trends in traditional assets. For example, they profited significantly from the bond market decline in 2022. They are specifically designed to perform when stocks and bonds crash simultaneously. This provides a crucial hedge against systemic risk events. Trend following works because market movements often persist longer than expected. Liquid alternative exchange-traded funds offer accessible exposure to these strategies. These ETFs are sometimes imperfect proxies for the underlying strategy. Investors must understand the underlying systematic methodology. Traditional fixed income is highly vulnerable to rising interest rates. This vulnerability exists because coupon payments are fixed for the bond's duration. Private credit, including direct lending, offers floating rate exposure. The interest rate on these loans resets periodically. This reset is based on a benchmark rate, such as SOFR, plus a spread. This floating structure protects the principal value from interest rate increases. Private credit typically offers higher yields than investment-grade corporate bonds. Yields often range from 400 to 800 basis points over the benchmark rate. Investors must accept reduced liquidity compared to public markets. They also take on higher credit risk in exchange for this yield premium. Private credit provides diversification away from public market volatility. It is an essential component for rate protection. The legal structure of alternative investments impacts tax efficiency. Direct commodity funds and many managed future strategies are structured as partnerships. These partnerships issue K-1 forms to investors annually. K-1s can significantly complicate tax filing, especially across state lines. They may also generate unrelated business taxable income, or UBTI. UBTI is problematic if held within retirement accounts. Liquid alternatives structured as 40 Act mutual funds or exchange-traded funds simplify reporting. They issue standard 1099 forms, which are easier to process. However, these liquid vehicles often use derivatives extensively. They may also have higher expense ratios than direct partnership structures. This can lead to increased tracking error relative to the underlying index. Investors must choose the structure based on their account type and tax tolerance. The modern resilient portfolio shifts away from the rigid 60-40 split. It moves toward a diversified risk budget approach. A potential allocation structure includes 40% global equities. Fixed income should be 30%, split between duration-managed bonds and private credit. Alternatives should comprise the remaining 30%. This 30% is split among real assets, managed futures, and gold. This structure prioritizes diversification across all economic regimes. These regimes are growth, recession, inflation, and deflation. The focus is on achieving consistent risk-adjusted returns. It avoids relying on the historical negative correlation of stocks and bonds. High inflation has permanently invalidated that correlation assumption. This new framework provides robust protection against future market shocks. Implement this structure to secure your wealth.